Hello everybody and welcome to this video where we will be running over the top 5 pharmaceutical companies. We have today selected the following 5. First, Johnson & Johnson, stock ticker J&J. Next one, PFIZER, stock ticker PFE. Then we have Merck & Company, stock ticker MRK. We have Bristol-Myers SQUIBB, stock ticker BMY. And lastly, we have ELI LILLY Stock ticker LLY. So Johnson & Johnson, PFIZER and Merck are all studying and trying to find a vaccine for the coronavirus, which is very important to them. Then we have Bristol-Myers SQUIBB, which are currently trying to integrate Celgene, the big acquisition that they did last year. So a lot of stuff going on here. All of these companies are obviously represented across a broad range of products within the pharmaceutical industry. So first we want to understand how these stocks have been performing in the most recent periods. Are they in what we consider an uptrend, downtrend, or are they going more sideways? And as we can see here across the boards, it's a little bit mixed and apples, with the exception of Eli Lilly, which for the last 12 months has actually gained almost 35%, which is really good. Bristol-Myers SQUIBB has gained almost 20%, so again, quite decent, but otherwise there hasn't been huge movement in these stocks. Next, we want to take a look at the income statement and how these companies are performing. Are they basically earning any money? And we like to look at the net income first, and we can see all of the companies are doing really well, with the exception of Bristol-Myers SQUIBB. However, Bristol-Myers SQUIBB, as mentioned before, did a huge acquisition last year with Celgene. At the same time, they have also increased their R&D quite significantly. So again, I'm not too concerned about this number, but otherwise it's looking quite well across the board. If we then go to the net profit margin average for the last 4 quarters, we can see that PFIZER is doing the best with 28.81%, followed by Merck with 22.38% and J&J with 18.9%. Next, we can take a look at the B/M score, which is a mathematical model that determines whether a company has manipulated its profits. And as we can see, it's looking quite well, except for both Bristol-Myers SQUIBB and Eli Lilly, which is scoring not too good and a small red flag for us. Next, the zone ratio, it identifies whether a substantial part of earnings are non-cash accruals, which we're obviously not interested in. We want this number to be between minus 10% to 10%, and except PFIZER, it's looking fine. Next, we just go in quickly and look at the status overview, and what we could see is that the stocks were actually not moving really anywhere. So for 4 of them, we have considered that they are moving sideways, and it's only Eli Lilly, which is considered to be in an uptrend. For the income part, all of them were positive except Bristol-Myers SQUIBB. However, there are good reasons for that. And lastly, on the ranking score, we could see that on the net profit margin average for the last 4 quarters, PFIZER was doing the best, followed by Merck, Johnson & Johnson, Eli Lilly, and then Bristol-Myers SQUIBB. So then we want to take a look at the return metrics and how high returns and cash flow margins is being generated by these companies. And first, we can look at the earnings yield compared to the S&P 500 average. And we can see across the board, with the exception of BMY, it is actually looking quite well. Then we can take a look at the return on invested capital benchmarked against the industry. Not looking too well for all the companies except Eli Lilly, which has an impressive 57.35%, really good number. On the levered free cash flow margin, looking quite okay. We're in the ranges 15% to 34%. I have today decided to add an important metric for these kind of companies, which is return on research capital, which basically just means how much return is there compared to the research and development that they put in. And the higher the number, the better. And as we can see across the board, it's looking quite well. PFIZER is doing the best of these companies. Next, we go into the balance sheet and ratios just to see how strong the financial position is. And if we look at first at the current ratio, we can see very well across the board, all of them above 1, and Eli Lilly doing the best. Cash ratio, Again, this is very capital intensive industry, so I wouldn't expect too great numbers here, but still small red flags here with the first 4 companies, and then ELI Lilly is doing really well here with 2.15. If we take a look at the total assets versus total liabilities, I want that to be above 1.5, and most of them are meeting the target. Again, ELI Lilly is doing the best. Debt equity ratio, again, it's a general metrics here, or general value that we're looking for, but all of them are scoring quite well. Then we have the Altman Z score, which is credit strength test that assesses the likelihood of bankruptcy, and we can see all of them scoring well, except BMY, which is, again, warning flag here. The same on the Piotrowski score, which assesses the strength of the company's financial position. All of them are scoring fine with the exception of BMY. Again, there may be something here in the numbers related to the Celgene acquisition, so it may not be as bad as it looks. It will have to be investigated further. Next, in the status overview, we saw on the return on invested capital that ELI Lilly was doing far superior compared to the other companies. On the levered free cash flow margin, all of them were doing quite well. However, BMY is doing the best, followed by PFIZER and then J&J. On the balance sheet part, ELI Lilly was doing the best on the title ratio, followed by Johnson & Johnson, and a similar story repeated itself on the debt equity ratio, where ELI Lilly was also doing the best, followed by Johnson & Johnson. Next, we want to take a look at the shareholder yield and how much value is returned to shareholders either through dividend and or buyback. If we first take a look at the dividend yield, we can see that J&J, PFE, MERCK, and BMY are all paying pretty good dividends, while as ELI Lilly is not paying anything. They actually cut it over the last 12 months. If we go to the buyback yield, it's a little bit different story. J&J pays a small one. PFE issued shares over the year, while as MERCK and BMY looking really well here with 5.5%, and ELI Lilly had a small and insignificant buyback. So that leads us to the total shareholder yield, as we can see here, which looks quite good for the first 4 companies. However, we want to understand if this is sustainable, so therefore we look at the modified payout ratio, which shows the proportion of earnings paid to shareholders in the form of dividends and buyback, and we want this number to be below 100 because that means that the company has more cash to pay out dividends and or buyback. If it's above 100, they do not have sufficient earnings to pay this, and they have to get the sources elsewhere. So looking across here, J&J, it's quite okay, while as PFE, MERCK, and BMY looks quite unsustainable going forward. They may have to scale back on either the buyback and or cut the dividends. Next, we want to take a look at the earnings per share and growth. So basically, we want to understand whether the companies are expected to grow in the future. So first, we look at the EPS growth forecast for the next 5 years. And benchmarked against the industry, we can see that J&J is only 5.08%, PFE 5.37%, and MERCK 6.25%, so all subpar to the expected for the industry, while as BMY, maybe due to the acquisition of Celgene, is expected to outperform the general industry with 22.2%, and the same goes with ELI Lilly with 13.18%. Really good numbers. Again, you cannot use the past to predict the future, but I still like to look at some of the numbers from the past to see if there's an indication. So one of them is to look at the revenue growth for the past 5 years. And it's quite interesting to see here that J&J, PFE, and MERCK, again, really poor numbers compared to BMY and ELI Lilly, which both have outcompeted them significantly. Next, in the status overview, we first look at the shareholder yield, and here we could see that Johnson & Johnson were paying the best compared to the modified payout ratio, followed by ELI Lilly, which almost paid nothing. It was very poor. However, for all the other companies, the modified payout ratio was so high that there is some concerns on whether these numbers are sustainable, so therefore they are scoring worse. There may be others who would argue differently. On the earnings per share growth forecast for the next 5 years, BMY followed by ELI Lilly was doing far better than the 3 others. The same story repeated itself on the revenue growth for the past 5 years. So this is an indication that these companies are expected to grow significantly more than some of these companies in the next 5 years. Next, we want to take a look at whether these companies are currently considered under or overvalued, and we have different ways of doing that. The first one is to look at the PEG ratio and the Peter Lynch fair value, and basically if the PEG ratio is below 1, they're considered undervalued. If they are above, they're considered overvalued. And as we can see here across the board, all of them compared to this metrics are considered overvalued. We cannot assess BMY due to the negative PE. ELI Lilly is the one that is getting the closest to 1, but again, still overvalued. Then we can take a look at my own estimated intrinsic value, which is based on a lot of different assumptions and numbers. And what I derive to is that the fair value upside or downside estimate on these companies are that J&J has a potential upside on 7.46%, PFE very attractive here with 11.67%, MERCK a small one and 1.11%, small downside on BMY on 1.31%, and a small potential upside on Eli Lilly on 0.14%, so nothing really extreme. We also have the beta ratio, which shows the risk volatility against the market, and as we can see, as all of these are less than 1, they are moving less than the general market. We can also take a look at some other value indicators. The first one is the book value per share, and based on that indication, all of these are considered overvalued, and there's no surprise in this. This is the common case when you benchmark on this. On the relative strength index for the last 14 days, we want that to be below 30 because that means that there's a buying opportunity. We want to avoid above 70. We can see all of them are in between here. But again, they're not too high, so there's a small signal that some of these may go into a buying signal if they drop a bit further. Next, I want to take a look at what the analyst perspective is. As you saw in my last video, I do not always follow these. Sometimes they have some strange recommendations which are based on their own agenda, but I do like to stay on the same side of them if possible. And as we can see here, they actually believe that based on the consensus price target, there's an upside on all of these companies. So that is really, really good to see. But again, I don't always take these numbers for granted because they sometimes have their own agenda. So to summarize all the indicators that we saw just before on the intrinsic value, the overall value assessment for these companies are actually that all of them are undervalued. I truly believe that all of these will have the potential to go higher in the future. I wouldn't be too concerned in investing in any of them. So based on all the information that we have run over, the CMD has selected the following top pick based on an outstanding return on invested capital of 57.35%, acceptable free cash flow margin of 15.38%, incredible strong balance sheet, second highest growth forecast, undervalued on several parameters, Eli Lilly. This is the top pick for us. We believe that there is good value if you want to go with Eli Lilly going forward. It's kind of like a safe choice. However, to be honest, we could pick all of these companies. We believe all of them are good and all of them have potential in the future. No matter which one you select, you will not go wrong in the city, we believe. However, you need to really make your mind up on which basis you're buying these stock. Is it for growth? You want to go with Eli Lilly or BMY. If you are maybe more for the safe dividend, you would more likely go with a company like Johnson & Johnson, who is the safest of all of them out there. We hope that you enjoyed this video. Please comment, like, subscribe for any improvement as well. Please let us know. We want to improve the content for you guys. Please also check out our Patreon site where you have additional bonus information not shown in this video. Besides that, have a good day, stay safe, see you next time.